Hey there, welcome back to my channel. In this video, I'll try and help you understand what short selling is. So if that's what you'd like to know, make sure you stick around till the end. For those of you who are joining us for the first time, we're all about teaching you how to become financially independent and show you how money works. We're here to give you the secrets of how to become rich and create a community where we can share knowledge, inspire others, and engage in meaningful discussions. Alright, enough talking, let's jump right into today's video. If you've watched the movie The Big Short, you might be wondering what shorting is. Short selling is a trading strategy used in financial markets where an investor sells borrowed securities with the expectation that their price will decline. Here's a step-by-step breakdown of how short selling works. The process of selling is not as hard as it used to be. Nowadays it's just by the click of a button. The most important thing you should understand is, when you sell and it goes up you lose money, and when it goes down you make money. That said, here's the outline of what happens when selling a security. Number 1. Borrowing. The short seller borrows the securities, which could be stocks, bonds, or other financial instruments, from a broker or another investor who holds the securities. Number 2. Selling. The short seller sells the borrowed securities on the open market, effectively creating a short position. The proceeds from the sale are held by the broker as collateral. Number 3. Waiting for price decline. The short seller waits for the price of the securities to decline. Their goal is to buy back the securities at a lower price to cover the short position and make a profit. Number 4. Buying to cover. Once the price has fallen to the desired level, the short seller repurchases the same securities on the open market. This is referred to as buying to cover or covering the short position. Number 5. Returning the borrowed securities. The short seller returns the borrowed securities to the lender. They no longer have any obligations or exposure to the securities. Number 6. Profit or loss. The short seller's profit or loss is calculated by the difference between the selling price and the buying to cover price, minus any transaction costs and borrowing fees. If the price of the securities increased instead of declining, the short seller would incur a loss. Here's a detailed example of how someone might engage in short selling. Our investor here, let's call him Michael. Michael believes that the stock price of company XYZ is overvalued and expects it to decline in the near future. Or maybe a damaging scandal happens, and he's very sure that the company will surely go down. Michael then conducts thorough research. He analyzes the company's financial statements, industry trends, and any other relevant information. Michael then plans to borrow the stock. He contacts his broker to borrow 100 shares of company XYZ's stock. Nowadays this happens with just a click of a button. The broker then finds another investor or institution willing to lend the shares and facilitates the borrowing process. The shares are then credited to Michael's account. So what does Michael do with the borrowed stock? With the borrowed shares in his account, he immediately sells them on the open market at the current market price. Let's assume they sell the 100 shares at $50 per share, resulting in proceeds of $5,000. Michael closely monitors the market for any price movements in company XYZ's stock. He is looking for a decline in the stock price. This is because he'll only make money when the stock price goes down and loses money if it goes up. He then has to buy to cover. If after a few weeks, Michael's analysis proves correct and the stock price of company XYZ drops to $40 per share, he'll then decide to close his short position and repurchase the shares to cover his position. Now let's do that easy math. Michael goes to buy back the 100 shares at $40 per share, hence spending a total of $4,000. The shares are returned to the lender, fulfilling the short selling transaction. Calculating the profit. The investor's profit is calculated by subtracting the cost to buy back the shares, which is $4,000, from the initial proceeds of the sale of $5,000. In this case, the profit would be $1,000 before considering any transaction costs or borrowing fees. In reality, things are not always that simple because the markets are very volatile. No one can ever be completely sure if the stock will go up or down.
Nobody knows if the stock is going to go up, down, sideways, or in fucking circles, least of all stockbrokers.
Market volatility refers to the degree of variation or fluctuation in the price of a financial instrument or the overall market over a specific period. It measures the rapidity and magnitude of price changes in an asset or market index. High volatility implies that prices can change dramatically in a short period, while low volatility suggests relatively smaller price movements. Our simplified example shouldn't make you think shorting only happens with stocks. Other financial securities can also be shorted. Several factors contribute to market volatility, including earnings reports where, if a company reports better than expected earnings, it can lead to increased buying interest and volatility. Conversely, disappointing earnings can trigger selling pressure and higher volatility. Investor sentiment where fear and panic can lead to selling frenzies and heightened volatility, while optimism and positive sentiment can fuel buying activity and increased volatility. And economic indicators where economic data, such as GDP growth, employment figures, inflation rates, and interest rate changes, can significantly impact market volatility. Positive or negative surprises in these indicators can lead to increased volatility as investors adjust their expectations. It's important to note that short selling can be a risky strategy. If the stock price had increased instead of declining, the investor would have incurred a loss. Additionally, there may be costs associated with borrowing the shares, such as interest or borrowing fees, which would reduce the overall profit. Short selling allows investors to profit from a decline in the price of a security, even if they don't own the security. It is considered a more speculative and risky strategy compared to traditional investing because losses can be unlimited if the price of the securities being shorted increases significantly. Rapid price changes can result in significant gains or losses, making it important for investors to carefully manage their risk exposure and implement appropriate risk management strategies. Additionally, some regulatory bodies may impose restrictions on short selling during periods of market volatility to maintain stability. And that's it. I hope you understand better about what shorting is. That's all I got for you today. Thanks for watching this far. I hope you enjoyed the video. Don't forget to hit that like button if you find this video helpful. And if you have any questions or suggestions, leave them in the comments section below. We love hearing from you. Goodbye.